Welcome back to the Halftime Report. I'm Mary Thompson with the Market Flash. We're taking a look at shares of Facebook, one of the best performers in the NASDAQ 100 today, now up 3.4%. Price target raised at Topeka Capital to $40 a share from $36 a share ahead of the company's earnings. Of course, they report on January 30th. Of course, that $40 price target still well below its post-IPO price of $45 a share. Scott, over to you.
Mary, thanks so much. New details emerging on a reported Dell buyout, with Microsoft possibly investing up to $3 billion, according to our very own David Faber. The stock's up 29% so far this year, but what does all of the speculation mean for shares going forward? Joe is our Dell bull. Mike's the bear. Gentlemen, we're going to debate it. Joey, you're up first.
Well, I'm just going to say that I've said that I believe that Dell is a turnaround story in 2013 and in essence is 2012's technology Yahoo. I still believe that. I still think right now I am long. I'm staying long even with the price at 13 and a quarter. I think the LBO deal will be presented, and I think there'll be a go shop provision within that deal that will allow for shareholders to go out and see if they can get an even higher price than what people are talking about.
I think if you were in Dell, as Joe was, down under 10, I think that's a great trade, a great time to buy it. But seeing the stock up here today, 13 and a quarter, when we're hearing 13.50 to 14 on a deal that may or may not get done, I think that's a terrible place to go in and buy the stock here today, because if this deal is scrapped, I think the stock pulls back 15 to 20% quickly.
I don't disagree with you if the deal is scrapped that there will be significant downside. However,
well, of course, right? I mean, stocks run up exclusively on the fact.
However, I believe number one that the probability of a deal being pulled off the table is relatively small. I think Michael Dell has clearly stated back in 2010 he gave a speech where he highlighted the desire to actually go private and slow down the process of which his company is viewed. But additionally, even on a pullback, I want to own this name. This name has done a great job in beginning to diversify, and now it's going to take what it has in its assets, try and monetize it, do it slowly. And to answer your question, again, I go back to what's the harder trade to make right now. The harder trade to make is to stay in this trade for what could be potentially a price north of 14.
Josh Brown, who made the more compelling argument on Dell? What do you do?
You know, I think this is a case where the easy money's probably been made, and maybe Michael Dell can get $1 or $2 higher, but quite frankly, the risk-reward is on the side of those who would take the profits and just let whatever happens happen. So I would have to come down on the side of Mike Murphy, do something else. This one looks as close to done as you get.
All right, the case is closed on Dell. Our next guest thinks the next leg for stocks is going to be higher. Erin Gibbs is Chief Investment Officer for S&P Capital IQ, $12 billion under management, and she is in the house today. It's nice to see you. Welcome.
Thank you.
So what's going to get us this 10% gain for stocks this year?
So there are a few things. One is obviously the improving unemployment rate. Another that we're finally seeing is a nice housing recovery. So with Bernanke's monetary accommodation, we think that's going to come up. And then finally, we're also seeing earnings growth. Right now, we're looking at 2013 earnings growth at about 6.4, 6.5%.
The parts of the market you think we should be in right now, or what?
So for 2013, the two biggest sectors for growth are consumer discretionary and financials. Now, this has been a consumer discretionary-led recovery so far, and we still like those. Particularly at S&P, we're focused on earnings stability, earnings quality, and those are where we like the most.
You have actual names
Yes.
you want to talk about?
Yeah, so two that I really like are Chipotle Mexican Grill. It's a real growth story. They've had very solid earnings in the past 2 years, as well as great earnings growth forecasted for this year. The other one, a little more contrarian, is Big Lots. Now, it's definitely more of a value play. But again, we've seen very strong cash flows, and particularly where it's trading now, we see it as a really good value.
On the Big Lots side of the story, I'm glad you mentioned the contrarian play, because most people may say you should stay away from this. I mean, there's a lot of insider selling.
Yep.
And there's also the FBI looking at some insider trading stuff with the CEO who's going to be retiring, right?
Yes. So we still see that those uncertainties, once those play out, they have the cash flows, they have the earnings, and this is something that can easily be a part of the recovery within the consumer discretionary
And on the other
space.
side, I guess Chipotle, I would say, okay, they say they're going to raise prices because food costs are going up. Are they going up too much?
For the forecast, we still see a solid growth. No, the Chipotle is still well priced within it, and it has it's a very unique space. One thing I mentioned Chipotle to my clients, and they all just, oh yeah, they're great.
Look, you go to any one, right, guys?
Yeah.
I mean, the lines are out the door.
Yeah, exactly. The people are willing to pay the extra 50 cents, $1 for it.
So I'm with you on the S&P rallying this year, but Chipotle, I have a question. I love the food, but with the prices going up, what's a fair value? Because if somebody like a McDonald's comes in there, which there's talk that they will, can't you see a Chipotle really coming back into a 20-25 multiple versus the 30 to 35 it's getting right now?
Right now, with the earnings growth, I still see it fairly valued. Honestly, and even if McDonald's come to the space, I mean, they've been talking about raising prices forever as well. They're all facing those that crunch within the higher commodity prices.
Well, what about the issues that are unresolved, right? If you look at, say, the market, okay, the market's going to gain 10% this year.
Yep.
I say to you, well, I mean, we still have the bickering in Washington. That's not going to subside anytime soon. What happens if the Fed takes the punch bowl away earlier than a lot of people want?
Yeah, so we have right now, we have a 10% forecast for the S&P 500 up for the end of the year. Brings us about 1,600. That is very much based on Bernanke giving us basically the QE infinity and continuing that, and that's through also again seeing the continued housing recovery. So that's definitely an absolute necessary.
Are there any areas in the market where you're having trouble finding buys, things that you might avoid outside of the discretionaries and financials?
Utilities and materials are two of the worst sectors, particularly for 2013, so we're just a big avoid across the board. Also, to answer your question, another concern that we have with the second half of the fiscal cliff, obviously the spending cuts,
right,
is within the industrials, defense, and then healthcare providers. And particularly with healthcare providers, not just the healthcare sector in itself, but with the Medicare cuts, the automatic cuts would represent about a 2% or 11 billion cut. And I don't see Obamacare offsetting all of that, particularly for the hospitals, the doctors, those types of companies. So one of the stocks on our void list is Tenet Healthcare, big hospital company. And I think that particular industry, that niche, is very vulnerable. And until, let's say, maybe the second half of the year, when we get all of these resolved, that's something that I'm telling our clients those are some of the avoids.
Thanks for coming in.
Thank you.
All right, it's good to see you, Aaron Gibbs. Guys, do you want to make some trades? Joey?
Financials, I think, are the place that you continue to look at right now. I love what we saw from Regions Financials this morning. Regional banks, capital market plays, Goldman Sachs, Morgan Stanley, just keep holding them.